Welcome, everyone. I'm Charles Bach, President and CEO of United Church Funds. I'm delighted to welcome you to this town hall where we're going to share what's going on at UCF, as well as in global markets and with the invested assets that we manage for your church organization. As we get started and as others are making their way in, I want to let you know that these town halls are being recorded. And the video and all materials presented here will be available on our website, probably starting tomorrow. During the webinar, we welcome and encourage questions. You can submit yours by clicking on the Q&A box. We'll answer them at the end, and if time runs out before we get to yours, we'll reach out afterwards. And a reminder that what you see and hear in these town halls is for general informational purposes only and should not be construed as giving any specific legal, tax, investment, or financial advice. Well, again, welcome everyone. I'm Charles Buck, President and CEO of United Church Funds, and I want to start off by sharing our deepest sympathies and condolences with the family of Brian Bottager, who was president and CEO of the Pension Boards, our sister financial ministry in the United Church of Christ. Brian sadly passed away this last weekend in Wisconsin. At UCF, we were privileged to work with Brian and his team at the Pension Boards, including the investment team, whom you'll hear from later in this webinar. We're all grateful for his leadership in and service to the church, and especially for his care and concern for the needs of all those who serve the church as ministers and employees. Brian's substantial contributions and legacy will be long cherished and remembered. Well, at our town hall back in November, we were meeting soon after the U.S. elections. And at that time, we didn't yet know which party would hold the majority in the U.S. House, but we knew who would be president. And because it was Donald Trump's second go-round, we had some idea or inkling of what lay ahead. Or so we thought. Come January 20, soon after the inauguration, and even before the sun had set in the west, we were blizzarded and blindsided by executive orders, and they kept coming in the next day and coming in the days after that. Regardless of our party or political leaning, it's hardly an exaggeration to say that these orders are far-reaching and aggressive. They're testing the limits of powers of the executive branch, and in some cases, they're stoking considerable anxiety and real fear or panic. They affect federal agencies, foreign aid, tariffs and trade, access to health care, private and public sector diversity initiatives, grants and funding for vital social services and clean energy, and even the safety and sanctity of our schools and churches. The verdict is still out on the full effects and consequences of all these changes, but hardly anyone will be unaffected. We'd like to know how you and your church or organization are feeling or reacting at the moment. So, coming up on your screens will be a poll we're going to take. I'd like for you to take a look at these statements here and mark the one that's closest to the way that your church organization is feeling right now in response to the changing political climate. So, we are not worried and are staying the course is the first option. We are somewhat worried but are unsure about which next steps to take. We are alarmed and starting to formulate a plan of action. And finally, we are on high alert and are mobilizing for direct action, or it could be none of the above. So go ahead, mark one, and let's just kind of take a temperature of the room here. We'll just take a few more seconds and see the results in a little bit. All right, interesting. So just a small percentage are not worried and are staying the course, but by far the most in between. We are somewhat worried, unsure about what steps to take, or we are alarmed and starting to formulate a plan of action. And there are a few who are none of the above. All right. Well, thank you for participating. Gives us a good sense sort of where we all are. I'll tell you that here at UCF, we're a mix of the first three. We are worried, We are formulating a plan of action and we are staying the course. We're trying to make sense of everything and assessing what impact that these changes will have on our mission and on our ability to serve you well in your mission. How we get there, that is our strategy, will have to be adapted to respond to new political realities. And we'll keep you updated on the things that we're doing. But what isn't changing is our commitment to being sustainable, responsible, and long-term investors on your behalf. We've been doing this for over 100 years, and we intend to keep doing it, not just for the next 4 years, but for another 100 years. Before you hear from the excellent team at UCF, I want to be sure that you hear the names of a couple of folks who are not listed in the agenda on the next page here. And they are our marketing and communications team of Debbie Wibowo and Adam Sank. They work tirelessly behind the scenes to make these town halls possible. Very warm, sincere thanks to Debbie and Adam. So I'm pleased now to introduce Kelsey Rose of our institutional relationships team to bring you first organizational updates. Kelsey?
All right, thank you, Charles, and a warm welcome to all of you who are joining us today for this first town hall of 2025. United Church Funds has been busy on your behalf over these past few months, and I am pleased to share several of the organizational updates. But first and foremost, UCF has a new Director of Client Services, DeAnna Cook. DeAnna is here with us, and we are excited for all of you to get to know her a little bit. DeAnna, welcome. Could you tell us a little bit about yourself and your professional background?
Hi. So I was born and raised here in New Jersey. I'm still happily at home here in Morris County. Most of my experience has been in the financial service industry, mainly operations and helping companies grow, building departments, teams, things like that. And a few years ago, it actually led me to a financial service technology company where I enjoyed being part of that industry and being able to use what I learned and did in operations to help, other companies embrace, new software and seeing how they could use that to, streamline their processes and procedures.
Amazing. You bring so much to the UCF team. What was it about UCF that drew you to join us?
It's a good one. I was really looking for a company that, not would only benefit from what I had to offer, but something I can actually align with their mission statement and something I can, truly believe in. UCF has a commitment to excellence to its clients, but it's also upholding social justice values for responsible, ethical, and sustainable investing. So, I really do believe that by our work here, we're empowering communities by giving local churches the resources they need and also reminding, the companies that we invest in of their, moral responsibilities.
Excellent. And one last question. What's your number one priority as Director of Client Services?
I can go on and on about this all day, but my top priority is to really just build upon the processes and procedures and policies that the staff's already created for our clients, and just, excuse me, making sure that we're still continuing to perform by the higher standards of service. We have a great team, Jason, Tiffany, Frederick, and I. We have industry-leading software that's allowing us to use automated tasks and find so many other efficiencies in our day-to-day. And what we did together is we, created a couple clear goals, set some milestones to help lead us, and we're happy for the opportunity to continue what we do, but at the same time, increase our capacity to do it.
Thank you so much, DeAnna. We are so excited to have you, and we look forward to working with you.
Thank you.
And as we transition back to the remaining updates on the screen, another way UCF is committed to making sure you have a positive client experience is to provide you with valuable educational resources. And now we have several new and excellent materials available for you and your organization. The first is the trustee checklist. It's a practical tool for trustees, investment committee members, and fiduciaries of a church or organization to help you in excelling in your role and to get the maximum benefits out of what is available to you from UCF. Check out the trustee checklist by clicking on the link in the presentation or through our website. And we also wanted to draw your attention to the most recent fund fact sheets. These are the Q4 2024 updated fund fact sheets, and they're now available on the UCF website for your use and review. And then another fantastic and educational resource for you, your church groups, and friends is the Just Investing podcast. If you enjoy listening to podcasts or simply staying up to date with the fascinating field of sustainable and responsible investing while hearing unique perspectives and stories from experts in this space, you'll love the Just Investing podcast. You can find the most recent episode linked here and stay subscribed for new episodes that arrive each month. And then, of course, there are a few UCF staff members traveling to several upcoming gatherings. Come say hello if you are planning on attending Prepared to Serve in New Hampshire this weekend, the ICCR Spring Conference or Responsible Investment Forum in New York, or the Chisholm Annual Meeting in Massachusetts. And then moving on to the next slide, February is Black History Month. This is a month where we reflect and recognize Black excellence and achievement through American history. And we would like to recognize the excellence of the Black-owned asset managers at United Church Funds. These managers include Exponents, a domestic core equity manager, Channing Capital, a small cap equity manager, and Aldbrass, which is a private equity manager in our alternatives and alternatives balanced funds. I also would like to encourage you to read a recent article reflecting on Black History Month at UCF through the link in this presentation and also available on our website. And with that, it is now my pleasure to welcome Matthew Illian, Director of Responsible Investing, to introduce our next poll question and to share more about the latest responsible investing updates at UCF.
Thank you, Kelsey. Yeah, let's go ahead and jump right into the poll question. So this is asking another question about your church or the organization you're a part of. Which of the following issues remain top priorities for you in your church organization? So again, we're looking for where you all are focused. You can actually, it says multiple choice, so feel free to check several of those if they all are equally top priorities. The first being racial justice, climate justice, reproductive health rights, worker human rights, private prisons, and then the last one, weapons and gun control. So if you would just take a minute and your perception of where your organization's priorities are would be something that we're interested in at this particular time. And while you're finishing that up, we'll post the results here as soon as enough votes come in. But we asked this question about 2 years ago. And so it'll be interesting to see how the results compare today versus where they were 2 years ago. And I see that here the results are out. And just like last time, racial justice is at the top. That actually hasn't changed. We were at 85% 2 years ago, and we're at 84% today. Climate justice at 62% is a little bit of a drop. Reproductive health rights is actually a significant drop from where we were. That was a 72% priority 2 years ago. And then private prisons, about similar to where we were, and weapons and gun control is actually a drop from where we were. So interesting. We appreciate this. We'll post the results from this poll and then contrast it, and we'll show you when we send out the recording, the results from 2 years ago, so you can look at those as well. But this is helpful just for us to get a sense of where, again, where your organization is at. I want to update you on some things that we're looking at and doing in the responsible investing field. We view ourselves and UCF as empowered by you, our investors, to be stewards of the assets, not just to grow the wealth, but to grow the wealth wisely and as good stewards to keep UCF's and the church's values in mind. One of the areas that everyone, and we're particularly focusing on right now is on this reversal that we're seeing in attention to racial justice and diversity. There was a major companies have been pulling back and dismantling their DEI programs. Some of the big names that come to mind would be Walmart, some of the tech companies, Meta and Amazon, Harley Davidson, John Deere. A lot of these companies just saying, "Hey, we're canceling those programs." The U.S. Appeals Court in December ruled that the NASDAQ can't impose diversity rules on its board. So it used to be that a board that was listed, a company listed on the NASDAQ had to have at least one female, or if it was all female, one male, and one person of an underrepresented minority, or explain why they didn't have that in place. And the ruling came out to say, nope, can't do that anymore, and they decided not to appeal. And then the Trump administration came out. Charles was talking about all the executive orders, one of which was focused on DEI programs in the government, but also suggesting that the agencies should go after all illegal private sector DEI preferences, mandates, policies, programs, and activities. So a clear shot across the bow to the private sector as well on DEI. And so we are naturally, concerned. We believe strongly that diversity is a strength, not a weakness. And so in January, we joined a number of other investors sending a letter to Walmart expressing our deep concern. We've met with them once already, have another meeting set up, and to kind of press them a little bit and understand what they're doing. Of course, they're saying, hey, internally, we are continuing to support diversity among our workforce. But the problem is they're not willing to say that publicly. What they're sharing publicly is that they're walking back from their commitments. And that's deeply concerning, particularly because Walmart has such a diverse workforce, diverse customer base. And so we're naturally concerned about how this is going to play out, even financially in the long run at the Walmarts of the world. On the other hand, we have companies like Costco and others who've said, no, we're committed to our diversity programs. And so we continue to see two paths. And I think some companies are evolving, even strategically, these programs, and others are running away in fear. And I would say Walmart seems to be doing more of the latter at the moment. At UCF, we are going to continue to use our votes to express our commitment to diversity and racial justice, in particular at shareholder resolutions that are calling on companies to dismantle their DEI programs. We're voting against those, and I'm happy to say we continue to be in the strong majority in that case of folks who don't want these companies to dismantle their programs. And additionally, we have practices in place that will vote against companies that don't have diverse boards. And this is we have different standards based on the country that you're in, but if the company doesn't have gender diversity, racial diversity, it's likely that we will be voting against the nominating director at those companies, and in some cases against the entire board if we feel like it's been years and they're not addressing this issue. So this continues to be a big issue, in addition to what Kelsey shared before about how we're using our investments also with diverse managers. I also want to talk about the shareholder resolutions that we filed, because currently the rights of investors and shareholders to bring issues before company boards are under attack. And there's been some rulings out and guidance to suggest it's going to be a lot more difficult for shareholders to bring issues to the shareholder meetings. But I'm happy to say we've also seen some good progress with the companies that we've been engaging. So two of our shareholder resolutions are focused on indigenous rights, and these are with the banks. We are, with the support of some indigenous led partnerships, have engaged with and filed shareholder resolutions at JP Morgan and Citibank. A similar resolution at Citibank received over 30% shareholder support last year, and we're expecting a drop in that this year, but we're hopeful that will, that strong support will still be there. However, these resolutions are being challenged at the SEC, and so we're waiting to hear back if the SEC is going to allow these to go to a vote. At Dollar General, we have an outstanding shareholder resolution calling on them to create an updated human rights policy. And this follows a shareholder resolution from 2 years ago where we called on them to do a human rights audit, and they found all kinds of gaps. And, one of the gaps was that they don't have a strong human rights policy that applies to their own employees. They have a good policy for their suppliers, but not internally. And so again, we're hopeful that'll go to a vote and get a strong result. The last 4 resolutions are seeking enhanced lobbying disclosure, and 3 of these are grayed out at International Paper, LabCorp, and Workday. And I'm happy to say that the companies agreed to and committed to enhance lobbying disclosure. There are, in 2023, corporations reported spending $5.6 billion on lobbying. And that's just the lobbying that gets reported. Probably a majority or a significant amount of lobbying is not reported, and it's often going through not their lobbyists that are part of their staff, but through indirect trade associations and other nonprofits. And so that's what we're calling on these companies to do, is to have clear oversight and to also clearly disclose these lobbying payments to investors. And historically, investors have supported this. When companies are asked by their shareholders to disclose the lobbying payments, we often get fairly strong shareholder votes. Over 25% is pretty strong in the shareholder voting world. And so we're glad that 3 of the companies have agreed with us, and they've committed to enhanced disclosure. And we're waiting to see if the Molina Healthcare is going to be able to go to a vote. Again, there's lots of movement right now in what shareholder resolutions can and can't go to a vote. So we have more to report to you on that, but I did want to share with you these 7 shareholder resolutions, and let our clients know that often these allow us to come to these agreements where you never go to a vote, you never see what the result is, but the company has agreed to some sort of environmental, social, or disclosure practice that we think is really best for the company in the long run. The last thing I want to talk about is updates to our screens. One of the foundational faith values of United Church Funds is that we do not want to invest in companies that have products or practices that are antithetical with the commitments that our faith values hold. And so you can see a list here of the products are on top, And then down below is more on the practices. So those companies that don't uphold environmental and labor rights harms are also, minimum levels there are also screened out. I will note that two areas that were added to the products list this year are on the alcohol production and gambling. And we review this list every year. We've got a social SRI committee, a Sustainable Responsible Investing Committee, that's charged with reviewing this every year. And really, out of the pandemic, I think there was a growing concern that, with the isolation, we were seeing a greater impact from the alcohol and the gambling. And we were also looking in particular at gambling being targeted at youth and online access, et cetera, and decided that we want to start screening out those companies that have, that's a major core tenet of their revenues. And so this year, our screens, if you add up all of the screens, it was 506 names or companies that get screened out in what we call our traditional or general portfolios. And then in our Beyond Fossil Fuels funds, there were an additional 140 names in those if you're an investor in the BFF funds. And this was an increase from the prior year of about 80 names. So, we added again that alcohol and gambling screens. And then each year, our research brings in kind of a new list. And so altogether, that's how you come up with the 506 names, or about 646 names in the BFF funds. And with that, I'm going to turn over the presentation to my colleague, Matt Wagner, Executive Vice President of Institutional Relationships, to talk about the markets. Matt, over to you.
Matthew, thanks so much for that review and for reminding our clients how important that our mandate to invest in a way that is in alignment with their values is important to us and to them. So grateful for that review. We're going to take the next 20 minutes here or so and walk through some market updates, some rear-looking performance numbers, and then we're going to bring our members of our investment team in to do a little bit of a Q&A. I would remind you that if you all have any questions, there's a Q&A box at the bottom of the page, and I would invite you to put your questions in there, and we will do our best to get to as many of those as possible before the end of the call. With that said, let's run through some market themes as we look back to last quarter. So you've heard a familiar theme from us and other institutional investors, this Magnificent Seven theme, the idea of this narrow band of global tech companies that were really driving the returns in the S&P 500. We saw less return in international developed and emerging markets as we had a strengthening to the US dollar. We're going to talk a little bit more about that as we move forward. Passive versus active has been a theme at UCF that we're going to share with you, that we've worked on over the last number of years, and that we would like to share with you today. And we've got a chart for that. Passive versus active is taking a look at passive investment strategies versus active investment strategies, and looking at sort of the popularity and use of those within balanced portfolios. As you heard from my other colleagues, policy remains uncertain, right? As we look to domestic politics, as we look to global conflict, and as we look to other factors around the world, many investors, including UCF, are fairly neutral in our portfolios at the moment, just kind of waiting to see where we go from here and what opportunities we can take advantage of. And then lastly, I would just note to you that particularly in our balanced funds, we remain very committed to the idea of diversification and asset allocation, tactical allocation, asset allocation approaches to meet long-term return needs of our clients. Of course, always taking a look through the lens of sustainability and responsibility. As we go to the next slide, This will be a familiar slide for those of you that have joined us in the past. And this slide really has three separate charts. On the far left, the half-page chart, you'll see performance of various indexes for the fourth quarter, 2024 year to date, and then 3, 5, and 10-year average annualized returns. And then the two charts on the right talk a little bit about interest rate environments. And you can see here as we look at the chart on the left, the S&P 500 for the year for 2024 led markets with a return of 25%, particularly good year for U.S. large cap equities. And I would also just draw your eye to the Russell 2000, which is the index we use for small cap stocks in the U.S., returning 11%. So a fairly significant disparity between large cap U.S. returns and small cap U.S. returns. As we look to global portfolios, the third line down from the top, the ACWI IMI, or All Country World Index, is a blended index of U.S. markets and international developed and emerging markets. You can see there up about 16.5% for the year. So when we take that global approach, you can see that return stream was again very positive for the year. When you look for bond returns, you can see sort of those indexes that are there in the middle of that page. And I would turn your eye to the Barclays Global Aggregate, down about 2% for the year. Bonds were a little bit up and down through the year with moves in interest rates. The 10-year Treasury ended the year at about 4.5%. We will more than likely will continue to see interest rates come down, and we've got a slide for that towards the end of the presentation as well. As we go to the next slide, let's take a look at the S&P 500 and sort of where it stands at the end of the year, and then as we cross over into 2025. We ended the year with the S&P 500 at almost 5,900. As we sit today at the market close, 6,144. So markets have U.S. large caps have advanced early in 2025, but particularly I want us to pay attention to the box on the left there, where you see PE ratio, and that's the relative valuation of the S&P 500. And you can see at the end of the year, we're at about 21.5 times forward earnings. We saw a similar number in early 2022, and back into before the pandemic in February about this time last year. This time in 2020, about 19.5 times forward earnings. So markets might be looking a little bit expensive at the moment, and we're going to talk with our investment team about ways that we're handling the valuations that we're seeing today. As we go to the next slide, I'd like to bring in my colleague Stacy Pettis, who will be walking through this slide, and then we'll also bring in our investment team. Stacy.
Thanks, Matt, and welcome again, everyone. I'll take the time now to introduce our investments team staff that is with us today, both Minothi Dhanaraj and Lan Kai. This first slide that we're looking at, I have a question that I want to pose to Minothi first. In looking at these charts that are pictured here, they tell us a story about U.S. large caps, specifically U.S. large cap growth stocks, significantly outperforming U.S. small cap. The chart on the left shows returns for 2024, while the chart on the right illustrates U.S. large cap leading U.S. small cap for over the past 8 consecutive years. Minothi, what were some of the important metrics that drove U.S. outperformance over the past decade, and what metrics might we want to watch to gauge a potential reversal or new emerging trends?
Right. Well, thank you, Stacy, for the really good question. There's been multiple factors that have led to large cap outperformance over the last decade. And I would say probably the most significant of which Matt spoke to earlier, which is the dominance of the mega cap technology stocks, particularly the Magnificent Seven, who've had very strong earnings growth, as well as multiple expansion over the past 10 years. This, in addition to the rise in passive investing, also which Matt had noted, has led to significant market concentration And now the Magnificent Seven is about 1/3 of the capitalization of the S&P 500. Additionally, other factors such as lower interest rates over the past decade, specifically for the large cap stocks, which have been able to get even more favorable rates than small caps, have been beneficial. And then generally, investors look for stability, and the larger cap stocks have created more stability, especially with uncertainty in the markets. To the second part of your question, in terms of what we might look out for going into the future, and Charles kind of spoke about this earlier in terms of a lot of uncertainty in the markets with the new administration. So I think some things to kind of look out for are, impacts from the tariffs and immigration that can impact inflation, reduction in corporate taxes that could benefit companies. And then also, like we noted, the valuations are quite high. So we really need to see that earnings are keeping up going into the future. So those are a couple of the items to keep an eye out for.
Great. Thank you, Minothi. This next question, as we shift into the next slide about active versus passive management, I will pose this question to Lon Kai. Lon, over the past decade, passive, also known as index investing strategies, have come in favor and over active investing strategies. However, despite the increase in popularity, it has not always translated to passive strategies outperforming active strategies. The question that I have for you, in knowing that UCF blends both passive and active investing strategies, how does your team align both passive and active strategies within our portfolios at UCF? And what are key factors that are used to identify investment managers for our portfolios on the platform?
Hi, Stacy. First, I agree with your observation that passive strategy, as in terms of market share, overtake active. But even with that, it doesn't necessarily mean that the active manager would underperform passive. So first of all, on this chart, this is the market share of passive index strategies in the US versus actively managed strategy. This is not about performance, it's just the market share. And as you can see from the market share on this slide, active management was around 74-75% of the market in 2009 and dropped all the way to 38%. And that's almost halved. And on the other hand, passive index is now 62% of the market. So what drives the performance of passive versus active? First of all, most of the passive index are market cap weighted, and Minothi and then several others mentioned about kind of concentrate leadership. So when the market leadership is narrower, and also the second element of passive index is that they don't have cash. So it is easier to fulfilling a self-fulfilling process, whether it is a straight up market or straight down market. Of course, the symbols are different when it's straight up and sim. So if you look at the last 2 years, we had a very concentrated leadership in the US market, and then it's a very strong upward momentum market. And therefore, the large cap US stocks active managers struggled. So at the UCF, we embraced that trend. And then for the large cap US stocks, we select screened index and quantitative enhanced index, which UCF investor has benefit from that. When their market's active manager could add alpha consistently, we use actively management managers, and that is in the emerging market and a part of the international market. Whether it is a quantitative enhanced index or a fundamental driven active managers, the factors that we use to find high quality managers are the same. They're the investment process, investment philosophy, people, and performance. And we hope to find the high quality managers to deliver good returns for the UCF investors.
Thank you. We are grateful for the work that the investments team has been doing on behalf of all of our clients. Matt, I'll turn it over to you.
Great. Thank you, Stacy. As we switch gears to the next chart, we're going to switch gears and talk a little bit about international markets, which we alluded to earlier, Manothi. And we mentioned the US dollar, and the US dollar really strengthened in the second half of 2024, and that is a headwind for returns. It just makes for a tougher environment for international equities. So my question for you is, our UCF balanced fund, our other balanced funds are from an equity standpoint are diversified between US and international markets. So how are we viewing international markets over the next couple of years, and how might the more attractive valuations that we're seeing in international markets play a role in future returns for balanced portfolios?
Yeah, thank you, Matt. So as you noted, we continue to maintain a diversified portfolio between domestic, international, and emerging markets. And as you can see on that slide on the right, the discount in the international markets is there across all sectors, so not just particular areas. Similar to the discussion on large cap versus small cap, there will be various factors that we have to take a look at, such as tariffs, interest rates, corporate tax rates, reshoring, and other factors. International investing is really important for diversification. And like you noted, there are better entry valuation points right now. And if we see the US dollar declining, it's going to benefit international markets, especially emerging markets. But as Lon noted, active management is really important in international and emerging markets, as it's really important to understand and know the local economies and policies in those places. To that point, year to date in 2025, thus far, we have seen international markets outperform US markets due to some of those factors in terms of valuations as well as the US dollar.
Excellent. Thank you, Manothi. Appreciate that. International markets have played a role in our balanced funds, and our investors have sort of said, yeah, but gosh, the Magnificent Seven, shouldn't we be, more weighted? And the importance of that diversification will eventually come through, and it certainly looks, at least early in 2025, like we might have seen a little bit of a comeback by international markets. So thank you for that response. Final slide before we go to Q&A. And again, I want to remind everyone, if you've got questions, you can put them in that Q&A box. I see that we have several already, and we will take some time at the end to answer those. I want to bring Lon back in. This isn't a market town hall or market update town hall call if we don't talk about interest rates just a little bit. And I know this is your favorite topic, Lon. So we're going to wrap up with that. And really, what I want to draw the eye of the folks that are watching here is the right-hand side of this, and where you see the dotted line. That's really sort of the market expectations, the sort of where we think rates might go from here. So Lon, my question for you, most investors predict interest rates coming down from current levels, which would be, of course, a tailwind for fixed income or bond investors. Do you concur with that? And how have we positioned fixed income in the balanced portfolios at UCF?
Yeah, thanks, Matt. I don't know if this is my favorite chart, but I'll give it a shot. So I concur your first statement, but not second half of the statement. So most of the market is expect Fed to cut 1 or 2 times in 2025. So we kind of agree on that. However, that doesn't mean that longer term interest rate will also move down. So what happened in 2024, if you all recall, Fed cut interest rates 3 times by 1%, yet 10-year Treasury went up 1%. this hasn't seen for very long. Although if people look at history, it happened before, and that was in 1981. And that's when the term bond vigilante was coined. And this time around, people are concerned about the amount of deficit and an ever increasing speed of the deficit. And then therefore, you see longer end interest rate move in a different direction of short interest rates. So in theory, when Fed cut rates, it should be a tailwind for fixed income, but it wasn't the case in 2024. In fact, because bond portfolio has duration, and I noticed there's a question from Carl. What was the year-end duration for the bond pool? It's about 6-year duration, and since the 10-year went up about 50 basis points, so it's a drag of 3%. Yes, you have coupon offsetting that, and then spreads tightening offsetting that. But then at the end of the day, the Gov Credit Index was only returned 1.2% last year. And to answer your second question is that with the current uncertainty in the policies, and Charles addressed that at the beginning of the town hall, we are actually stay almost close to the benchmark weight in various balance fund. The Alternative Balance Fund, the BFF Balance Fund, and the UCF Balance Fund. Slightly overweight in the equity and then slightly underweight fixed income at the moment. Nothing dramatic because it is an uncertain world that we're living at the moment.
Indeed, it is. Thank you so much, Lon, for that full response. And certainly, bond exposure has played a part in our portfolios, particularly the balanced portfolios at UCF, as not only a little bit of a downside hedge for equity volatility, but also now that interest rates are up a little bit as a second source of return for traditional funds. Let's move to the Q&A, and I do want to go through a number of the questions that we got. We got a number of questions on the fund fact sheets. The fund fact sheets are typically published about 6 weeks after the quarter close. They are available on the website. But I would also tell you that if you just need to see fund performance, net of all fees against benchmarks, that performance is typically produced a couple weeks after the quarter close. So we call that our quarterly performance report. You can find that on our website. And again, then those fund fact sheets that have quite a bit more detail about each one of the funds, that takes us a little longer to produce. And so again, about 6 weeks after the quarter close. Moving on here, we had a couple of questions, and Matthew, if you want to jump in here, we had a couple of questions on shareholder resolutions and proposals. Ken Birch had the question: if shareholder proposals are less possible going forward, will we take other voting actions such as voting against directors? And then a question from Eric Carlson: which other investors are participating with UC funds in the shareholder resolutions? Are we leading? Are we co-filing? So Matthew, take those couple of questions for me, would you?
Great. Yeah, so we do vote against directors currently, and I do think that what they call vote no campaigns, where investors try and get a marketing campaign to bring in new directors, push others out for a variety of reasons, will become more significant going forward. But directors typically get 94% support, so it's tough to really get a campaign that works. I think the one that was the biggest splash was at Exxon, when 2 of their directors were voted out, and 2 with more of an environment, or actually 3 with a more environmental focus and background came in. And then the question on the shareholder proposals, we do both. Sometimes we're leading. Of the 7 we filed, 5 of those resolutions we were the lead on. In 2 cases, it was others who were the lead, and we were co-filers. And this is the power of coalitions and having friends who are about this work as well.
Thanks, Matthew. Appreciate it. 2 other, while I have you off mute, 2 other quick questions, and these are really good questions. Does UCC invest in Tesla? What are the ethics of that? And then Larry Ricketts had a question about Amazon's carbon footprint. and sort of rationalizing that with BFF. Do you want to talk a little bit about maybe how we would engage with those companies to change their behavior over time?
Well, yeah, that's the thing. I mean, so some companies you can, they're willing to come to the table and listen, and others maybe not so much. I mean, to the Beyond Fossil Fuels portfolio, we do have a strategic goal of having the carbon emissions in that portfolio be below 50% of the benchmark. And so, and we've been able to hit that goal from already. And so, that portfolio is a low carbon intensity portfolio. But quite frankly, the investor community who have this SRI bent or a kind of a sustainability bent have been trying to pressure corporations to come out with climate transition plans for a long time. And part of the blowback that we're seeing is that corporate America has decided it's too much. And I don't think that means we are going to give up in any way. But I do think that it's going to be, that's why it's harder for us to file shareholder resolutions now, because of the lobbying work that they did for the last few years to get us to this point. So we're going to continue to be at the table. There's a lot of companies that understand that this is that we are going through a climate transition and we have to go to a low carbon economy. It's happening whether big oil wants to or not. And so we need to plan ahead, and companies are doing that. They're setting net zero goals, et cetera. My guess is though they're going to get there a lot slower over these next few years than we would have otherwise. And we just need to prepare and be ready for when the climate is ready now to be able to press on that and see some more, some quicker progress.
Great. Thank you for those answers. Appreciate it. Ann McCorkindale had a couple of questions related to asset allocation between domestic and foreign equities, and then the performance of the International Equity Fund. And so, Manothi, I would like to bring you in, if possible, regarding our international equity managers. I know we have had a little bit of underperformance for one manager, although that manager has done really well since inception. It's been more of a near term. Maybe just talk a little bit about the confidence that we have in those international managers and our relationship with them.
Sure. So, like you noted, we have two international equity managers. One's a active strategy and one's a quant strategy. One more focused on value, the other on quality growth. And then we also have an emerging markets strategy. And the international value as well as the emerging markets has been doing pretty well and in line with our expectations. The quality growth, they have been lagging quite a bit for a little while now, but they have really been sticking to their investment, like Lon noted earlier, what we look for in terms of investment philosophy, process, performance, and the team. And they're hitting all cylinders on those first three. And it's just the performance that's currently lagging, but we are starting to see a turnaround. And that they have made a couple of changes in their portfolio, which should benefit them going forward. And so we do have confidence going into the future in terms of that manager, but the other two are doing well.
Excellent. Thank you for that. And Ann did have a question as well about our sort of our overall current allocation between domestic and foreign stocks. If memory serves, last week when our investment committee got together, we were pretty neutral to the MSCI ACWI benchmark at the time. We weren't significantly overweight or underweight US to international stocks right today. Is that correct? Yeah.
That's correct.
Excellent. Well, we do like to keep this webinar under an hour. I know there are a couple of questions out there that we did not get a chance to return or to answer, but I think we got to the vast majority of them. We will take a look at the Q&A after this call is over, and if we weren't able to get to your question, we'll do our best to reach out in the coming days with a response. I want to thank all of my colleagues for joining us on this call. And also, I'd like to thank all of the folks who joined us here this evening. I think we had a record attendance for this event live. And we're really grateful that you were able to take the time with us to learn more about sustainable and responsible investing, to learn more about what markets have in store for us as we move forward into 2025, and to hear about how our values align with your values in our mutual mission to fund your ministry. Again, very grateful for your time. Thank you so much. Have a wonderful evening.